Hi everyone, today we'll be going over accounts October-November 2021, paper 2-3, question number 1. This is structured paper 2, which consists questions of 90 marks, and it also has a time limit of 90 minutes. And since question number 1 is of 30 marks, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. The following information has been extracted from the accounting records of T Limited at 30 June 2021. We have inventory at 1st July 2020, which will be the opening inventory, right? Then we have inventory at 30 June 2021, which will be the closing inventory. Then we have the rate of inventory turnover, and we're also given the gross profit margin. Alright, so firstly, we need to calculate for the year ended 30 June 2021 the cost of sales. So by looking at the given information, what we can deduce is that we will have to find the cost of sales with the help of rate of inventory turnover. So let's just first write the formula for rate of inventory turnover. So rate of inventory turnover is just going to be the cost of sales divided by the average inventory. Now, we need to figure out the cost of sales, right? We already have the rate of inventory to be 8.8 times. Now, what we need to figure out is the average inventory. So let's just find that first. So the formula for average inventory is opening inventory plus closing inventory divided by 2. So we already have the opening inventory right here, which has the value of 46,800. Then we have the closing inventory's value to be 54,200. Then we just divide it by 2. So our average inventory is going to be 46,800 plus 54,200 divided by 2, which gives the value of 50,500. Now we will just substitute these values into our first equation. So the rate of inventory turnover was 8.8. We need to figure out the cost of sales, and the average inventory is 50,500. So now this is a very simple equation. So the cost of sales is just going to be 8.8 into 50,500, which gives our final value of 444,400. Okay, now secondly, we need to figure out the revenue. So we already have the value for the cost of sales, and if we look at the given information, there's a fourth one, which gives the gross profit margin to be 45%. So what this means is that out of the total revenue, 45% is going to be gross profit, then the remaining 55% should be the cost of sales. So if we were to write it down in the form of an equation, then we can just say that 55% of revenue is cost of sales, right? Now we already know the value for the cost of sales. For 55%, we can write it down as 0.55 times revenue. It's just going to be 444,400. So this is a very simple equation. Now revenue is just going to be 444,400 divided by 0.55. So this gives the total revenue to be 808,000. Alright, this concludes the first part. Now we can move to the second one. We are given additional information, and the balances were extracted from the books of account at 30 June 2021. We're again given another set of additional information. Let's have a look at the question first. We need to calculate the balance of the provision for doubtful debts at 30 June 2021. So in the above information, we will look for those items that will concern the provision for doubtful debts. Let's do that. So firstly, obviously, the provision for doubtful debts is a certain percentage of trade receivables. So this is the information that we need to consider. Then let's have a look at the additional set of informations. The first one concerns with debentures. Second one is for the wages and salaries. Then we have information relating to bonus. Then we have expenses to be allocated to administrative and distribution costs. We have depreciation. For the sixth item, we have a credit customer owing 2360 from 21st April 2021 had been declared bankrupt and the debt is to be written off. So this is a bad debt. So obviously, if we're calculating the provision for doubtful debts, we first need to subtract the bad debts from our trade receivables balance and then multiply it with the rate of the provision for doubtful debts. So this is an information that we need to consider. Then we have age analysis of trade receivables at 30 June 2021. So out of the total net trade receivables, so net trade receivables is just the value we get after deducting the amount to be written off from the trade receivables balance in the above table. So out of that value, 75% is the net trade receivables of 0 to 60 days, 15% is of 61 to 90 days, and 10% is of over 90 days. Again, this is information that we need to consider. For the eighth one, we have the provision for doubtful debts. So for the debts between 61 and 90 days, we need to calculate the provision for doubtful debts with the rate of 2.5%, whereas for the debts over 90 days, we will be calculating the provision for doubtful debts with the rate of 10%. Now, in order to figure out the provision for doubtful debts balance at 30 June 2021, firstly, we will have to figure out the net trade receivables by subtracting this bad debt from the balance given in the above table. Then we need to allocate the 15% to 61 to 90 days and 10% to over 90 days. And we can completely ignore 0 to 60 days because we can see that the provision for doubtful debts are to be maintained for debts over 60 days, right? So we can just completely ignore the first part. Then after figuring out the net trade receivables with respect to the days, we can just multiply it with the rate for the provision for doubtful debts and figure out our required balance. All right, so let's just first figure out the net trade receivables. I will write it down right here. So net trade receivables. For this, we first require the balance given in the above table. Let's have a look. The trade receivable amounts to 110,360. Let's write it down. Now we need to subtract the bad debt amount that was given in our sixth information, which amounts to 2,360. Let's subtract this. So that's 2,360. Now this gives us the net trade receivables of 108,000. All right, so I'm just going to write it down in table format. So we have debt days. We can completely ignore 0 to 60 days because we are not allocating any provision for doubtful debts relating to that particular time frame. So we have 61 to 90 days and we have over 90 days. Then we'll figure out the net trade receivables. Let's have a look at the rate. So for 61 to 90 days, we will be allocating 15% of the trade receivables, whereas for over 90 days, we will be allocating 10% of the trade receivables. Let's write those rates down. For 15%, we can just write it down as 0.15. For 10%, we can write it down as 0.10. Now we will just multiply our net trade receivables of 108,000. So that's going to be 15% times 108,000, which gives us the amount of 16,200. Now again, we multiply it with the amount of net trade receivables. So this gives us 10% of 108,000, which is going to be 10,800. Now we figure out the provision for doubtful debts. So let's have a look at the rates. So for the debts between 61 to 90 days, we will be multiplying it with the rate of 2.5, whereas for debts over 90 days, we will be multiplying it with the rate of 10%. Let's do that. For 2.5, we can just write it down as 0.025, and for 10%, we can just write it down as 0.10. Now we multiply the respective net trade receivables. So the net trade receivables for the debt between the time frame of 61 and 90 is 16,200. So we multiply it with that. Now this gives 2.5% of 16,200, which is 405. Now again, for the debt over 90 days, we will just multiply it with their corresponding net trade receivables, which we figured out to be 10,800. Let's multiply that. Now this gives 10% of 10,800, which is going to be 1,080. Okay, so the final balance of the provision for doubtful debts we just have to add this total, right? So that's 405 plus 1080, which gives the required balance to be 1485. Alright, this concludes the second part. Let's move to the third one. We need to prepare the income statement for the year ended 30 June 2021, and we need to use this space on the next page for our workings. Alright, so for the first three parts, revenue, cost of sales, and gross profit, we already figured out the revenue and cost of sales in the first part. We can just substitute those amounts. Let's have a look. So our revenue was 808,000, whereas our cost of sales was 444,400. Let's just write it down. So revenue, that's 808,000. Cost of sales, that's 444,400. We need to subtract the cost of sales, so I'm just going to write it in a bracket. Now for gross profit, that is just going to be the difference between revenue and cost of sales. So that's 808,000 minus 444,400, which gives the gross profit to be 363,600. Alright, now we need to figure out the administrative expenses. In order to do so, we'll have a look at the above information and figure out the items that we need to record under that particular heading. So the first one is the balance given in the table for administrative expenses. Okay, this is the one. Then debentures, that's not going to fall under administrative expenses. This is actually interest paid on debentures, which we need to record in our finance costs. Then we have wages and salaries outstanding. Let's just adjust this amount. So we have the wages and salaries balance to be 88,300, and if we are owing that amount, it means that this particular amount of 3,800 relates to this particular year. So this is an expense of this particular year, which means that we need to actually record it in our income statement. So let's just add it to the wages and salaries. That's 88,300 plus 3,800, which gives the total wages and salaries to be 92,100. We're done with this information. Then at 30 June 2021, a bonus was due to be paid. So this is bonus outstanding to the sales director. So this is an expense concerning towards the sales. So this is not recorded under administrative expenses, but this is allocated towards the distribution costs. Then we are given expenses to be allocated. So for administrative expenses, we are given it right here. We need to allocate 30% of wages and salaries, and then 75% of directors' remuneration to administrative expenses. So that's the third thing that we need to record under the administrative expenses. Then we have depreciation. So the first one is motor vehicles for office staff. So administrative expenses actually record all of those expenses regarding office, right? So since this is a motor vehicle utilized for office staff, this depreciation should also be charged towards the administrative expenses. Then we have the amount to be written off to administrative expenses. So obviously this should also be recorded. Then where I have the provision for doubtful debts is to be charged to administrative expenses. So there's the provision for doubtful debt at the end balance was, we figured it out to be 1,485. So we just need to compare it with the opening balance. So opening balance is right here. So that's 1,235. So obviously there's an increase. Let's just figure that out. So increase in provision for doubtful debts. That's just going to be the difference between the ending balance and the opening balance for provision for doubtful debts. So the ending balance was 1,485. Opening balance is given right here, which is 1,235. So the difference or the increase is of 250. So this is the amount that we need to record in our income statement. All right, I think that sums up the items that need to be recorded under the administrative expenses. So let's just write it down. So firstly, we'll start with our balance. Then we need to allocate 30% of wages and salaries. Then we allocate 75% of director's remuneration. Then we have bad debt. Then we have the increase in provision for doubtful debts. I think we missed something. Oh, there was also the depreciation on motor vehicles. Okay, now we just need to substitute the amounts. So let's have a look at the table in order to find the balance amount, which is 55,900. Let's write it down. Then we have 30% of wages and salaries. So wages and salaries, we adjusted the outstanding amount and figured it out to be 92,100. Let's write that down as well. So 30% can be written as 0.30. And we just multiply it with the amount of 92,100. Then 75% director's remuneration. So 75% can just be written as 0.75. And the director's remuneration was given in the above table, which was 62,400. Let's write it down. Alright, then we have bad debt. So that amounted to 2,360. Then the increase in provision for doubtful debts, we just figured it out recently, so that's 250. Then we have depreciation on motor vehicle. So that amounted to 26,400. Let's write that down. Okay, so the total for administrative expenses is going to be 55,900 plus 0.30 times 92,100 plus 0.75 times 62,400 plus 2,360 plus 250 plus 26,400, which gives us the total of 159,340. So we will be writing this amount in our income statement. Let's do that. 159,340. And since this is an expense, we just write it in a bracket indicating that this needs to be subtracted from the gross profit. Now for the next part, we need to figure out the balance for distribution costs. In order to do so, let's have a look at the information in order to figure out the items needed to be recorded under this particular heading. So we have the balance for distribution costs right here. Then we have a bonus. As we said before, since this relates to sales, so this expense should be recorded under the distribution cost. So we need to adjust this bonus as well. Then the allocation of expenses is going to be 70% of wages and salaries and 25% of director's remuneration. Then for depreciation, since delivery vehicles is related to sales, this particular depreciation should also be charged towards our distribution costs. And yeah, I think that's it. So let's write it down. So firstly, we have the balance. Then we have our bonus. Then we allocated 70% of wages and salaries and 25% of director's remuneration. Then we had the depreciation on delivery vehicles. Now we need to write down the actual amounts. So the balance was given in our table to be 59,200. Let's write that down. Then there was a bonus. So bonus was of 12,000, which is given right here. So that's 12,000. Then we need to allocate 70% of wages and salaries. So that can be written down as 0.70. And wages and salaries was given right here. So that's 92,100. Then we allocate 25% of director's remuneration. And director's remuneration was included right here, which amounted to 62,400. Then there's depreciation on delivery vehicles. So that was given to be 32,800. Let's write it down. So the total for distribution cost is going to be 59,200 plus 12,000 plus 0.70 times 92,100 plus 0.25 times 62,400 plus 32,800, which gives the total to be 184,070. This is the amount we need to record in our income statement. So let's write it down. So that was 184,070. Again, since this is an expense, we need to record it in a bracket indicating that this needs to be subtracted. Now, in order to figure out the profits from operations, we just subtract the administrative expenses and distribution costs from the gross profit. So that's going to be 363,600 minus 159,340 minus 184,070, which gives the profit from operations to be 20,190. Finally, we need to figure out the finance costs. Again, let's have a look at the above information. So finance cost balance is given right here, and it amounted to 6,350. Then obviously there's only one item relating to the finance cost, which is the interest on debentures given in our very first information. So the 8% debentures were taken out on 1st November 2020. So let's just write down the months. So that's November, December, January, February, March, April, May, June, since our year is ending at 30 June 2021. So the debenture was used for these 8 months. And then interest was paid every 3 months in arrears. Arrears means that at the end of every 3 months, the interests were paid. So if we're talking about starting from November, so the 3 months is November, December, January. So the interest is paid right here. Then for February, March, April, the interest is paid right here. But for these months of May, June, the interest will be paid after July. But since this 2 months relates to this particular financial year, we need to include the finance cost or the interest charge for these 2 months as well, right? So this is the outstanding interest for this particular year, which relates to 2 months. Alright, so the rate for debentures is 8% and the total amount for debentures is 96,000. Let's just figure out the outstanding interest. So outstanding interest relates to 2 particular months. So if we are to multiply the debenture amount with the debenture interest rate, this gives the interest for total 12 months, but we only require the interest for 2 months. So we can just multiply it with 2 by 12. Right? So this gives the outstanding interest to be 1,280. So the total amount to be included in our finance cost is going to be the balance, which is of 6,350, and then our outstanding interest of 1,280. Let's write it down in our working section. So for finance cost, we have the balance and outstanding interest. So the balance was of 6,350, and then we figured out the outstanding interest to be of 1,280. This gives the total finance cost to be 7,630. So this is the amount we need to include in our income statement. Let's do that. So that's going to be 7,630. Again, we need to write it in a bracket because this is an expense, and we need to indicate that this needs to be subtracted. Now, in order to figure out the profit for the year, we just need to subtract the finance cost from profit from operations. So that's going to be 20,190 minus 7,630, which gives the profit for the year to be 12,560. Alright, this concludes our income statement as well as the third part. Now we can move to the fourth one. We're given additional information regarding the transactions that had also taken place during the year ended 30 June 2021, and we need to prepare the statement of changes in equity for the year ended 30 June 2021. So we are already given the opening balances for ordinary share capital, share premium, revaluation reserve, and retained earnings. Now let's start with the very first transaction. So the date was 1st July 2020, and the transaction was that the freehold property was revalued downwards by 10,000. So if it were to be revalued upwards, we would have added this amount in our revaluation reserve. But since it's downwards, we just need to subtract this amount. Let's write that. We can term it as revaluation. And we need to subtract 10,000 from the revaluation reserve, but we can see that it only has the amount of 7,500, which cannot sustain our complete amount of 10,000. So we will just be subtracting the 75,000 from revaluation reserve. So out of 10,000, we subtracted 75,000, but we again have a remaining balance of 2,500. So this amount also needs to be subtracted. Now, this will be subtracted only from the retained earnings. That's the thing to remember. So that's 2,500, which gives us the total of 10,000. And the revaluation does not affect ordinary share capital and share premium in any way. This concludes our first transaction. Then the second one was 1st July 2020, made a rights issue of 1 ordinary share of $2. So this is the nominal rate, right? 1 ordinary share is of $2, each for every 2 shares held. This was offered at a premium, so we also have a premium of 0.75, and the issue was fully subscribed. Okay, so I'm just going to write it right here. 1 ordinary share was issued as a rights issue for every 2 shares held. So for 2 ordinary shares, we gave 1 right share, right? Now for 1 ordinary share, we gave 1 by 2 right share. Now in order to figure out the total right shares issued, we first need to figure out the total number of ordinary shares that we have. So we have the value of ordinary shares right here. Now, in order to figure out the number of ordinary shares, we just divide the value of the ordinary shares with our nominal rate. So that's going to be 440,000 divided by 2, which gives us 220,000. So this is the number of shares in our company. So for 220,000 shares, we need to figure out how many right shares did we issue. So that's 220,000 ordinary shares. We gave out 220,000 times 1 by 2 right share, which is 110,000. So this is the number of right shares issued. Now let's figure out the value of right shares. So value of right shares that need to be recorded under our ordinary share is going to be 110,000 times the nominal rate. That's an extra 0. So nominal rate is $2. So we just multiply it with 2, and this gives the value to be 220,000. Now this is the amount to be recorded in the ordinary share capital. Let's write that down. We can write the heading as rights issue. And for ordinary share capital, we have the amount of 220,000. Now what we know is that this was offered at a premium of 0.75. So we also have the share premium. So for share premium, we need to record 110,000 shares issued at 0.75. That's the premium rate. So this gives the total value to be recorded in our share premium to be 82,500. Let's write it down. Now, rights issue does not affect revaluation reserves and retained earnings at all. So the total that we issued in our rights issue is just going to be 220,000 plus 82,500, which gives 302,500. This needs to be recorded in the total column. Let's move to the next transaction. We made a bonus issue of 1 ordinary share of $2 each. Alright, so this is just a note. So bonus issue can never be made at a premium because while issuing a bonus share, the company actually invests its own reserves amount into the share capital rather than taking in any cash from outside parties. So that's only possible if we issue it at a nominal rate. And each for every 10 shares held, reserves were left in the most flexible form. Okay, so what we have is that we issued 1 bonus share for 10 ordinary shares. 10 ordinary shares, that's 1 bonus share. Then for 1 ordinary share, we issued 1 by 10 bonus shares. Now we need to figure out the total number of shares that we held at that particular date, which means that we need to figure out the total number of shares for these 2 values of the ordinary shares. Let's do that right here. So number of ordinary shares is just going to be 440,000 plus 220,000 because these are the values of our ordinary shares till that particular date. Then we divide it with our nominal rate. So that's just going to be 330,000. That is the number of shares we have in our company. Now for 330,000 ordinary shares, we will be issuing 330,000 times 1 by 10 bonus shares. So that gives us the total number of bonus shares to be 33,000. Now, since we know that the bonus shares cannot be issued at a premium, so we only record the amount in our ordinary share capital. That's just going to be the number of bonus shares, which is 33,000, times our nominal rate, which is 2. So this gives the value of the ordinary shares to be 66,000. So this is the value that we raised by issuing the bonus shares. Let's write it down. We can just write it down as bonus issue. That's 66,000. And like I said before, while issuing bonus shares, the company doesn't take in cash from outside parties but utilizes its own reserves. So the very first reserve that we utilize while issuing bonus share is share premium. And we can see that we have the balance of 82,500, which can easily sustain the amount of 66,000. So we just transfer 66,000 from share premium to ordinary share capital. While doing so, we need to deduct this particular amount from share premium. So the total for bonus issue is always going to be 0 because the amount that we added is subtracted from another column. Let's have a look at another information. Then we have paid a dividend of 0.05 per share on all shares in issue at that date. So we paid dividend. Now all shares means that these three values, we need to figure out the number of shares for that particular values. So that's 440,000 plus 220,000 plus 66,000, and we divide it with the nominal rate of 2. So this gives the total number of ordinary shares that we currently have to be 363,000. So this is the number of shares. Then we paid the dividend of 0.05 per share. So for every share, we pay the value of 0.05. Then in order to figure out the dividend amount, we can just multiply the rate with this particular number of shares, right? So dividend is just going to be the number of shares, which is 363,000, times the dividend rate of 0.05. This gives the total dividend paid to be 18,150. So dividend is obviously paid, which means that our retained earnings gets deducted by that particular amount. So we just need to subtract the 18,150 from retained earnings. Again, dividend does not affect the share capital, share premium, and revaluation reserve in any form. Now, most people tend to forget this, but we also add the profit for the year in our retained earnings. Let's have a look at our income statement in order to figure out the profit. So that was 12,560. So we just add this amount to the retained earnings. That was 12,560. Okay. This concludes all of the items that we need to record. Now we can just figure out the closing balance. For ordinary share capital, we just need to add all of these amounts. So that's going to be 440,000 plus 220,000 plus 66,000, which gives the closing balance to be 726,000. For share premium, that's going to be 82,500 minus 66,000, which gives 16,500. For revaluation reserves, that's 7,500 minus 7,500, so there's no closing balance. Then for retained earnings, we have 86,320 minus 2,500 minus 18,150 plus 12,560, which gives a total to be 78,230. And for the total column, that's going to be 533,820 minus 10,000 plus 302,500 minus 18,150 plus 12,560, which gives the total to be 820,730. Now there's a way to cross-check. We just added the total by the columns, right? And we can also add these closing balances in order to figure out the total. If it's the same amount, then we can conclude that our solution is correct. All right, this concludes our statement of changes in equity as well as the fourth question. Let's move to the fifth one. We're given additional information. The directors make use of accounting ratios to interpret the information contained within the financial statements. Now, for the first part, we need to state the formula for calculating the non-current asset turnover. So the formula is just the revenue amount divided by the non-current assets. And for this particular value, we record it at the net book value. So that's net book value. So the formula is revenue divided by non-current assets value, which we record at the net book value. Then for the second part, we need to state what information the directors would obtain from calculating the non-current asset turnover. So non-current assets turnover essentially provides the information regarding how efficiently the business is utilizing the non-current assets in order to generate the revenue. Let's write that down. How efficiently the business is utilizing non-current assets to generate revenue. Alright, this concludes the fifth part. We can move to the sixth one. We need to state 3 limitations of ratio analysis when comparing the performance of businesses in the same industry. Okay, the first one is that the values that we use in ratio analysis are actually based on historic data. This is because by the time the financial statements of a company is published, there is actually a time gap of maybe 6 months to a year, right? So that particular ratio is obviously relating to the company's performance a year back or maybe 6 months back. So that's not very accurate while comparing the performance, because it does not actually give us the real-time value or the real-time performance of the businesses. So that can be a limitation. The second one is that during ratio analysis, we only use numbers. We only look at our monetary values and the numbers generated by the business, but we do not look at the non-financial factors, like how the staffs are so motivated and so loyal to the company. We do not actually record it in our financial statements, right? So that can be a disadvantage as well. Let's write it down. Non-financial factors are ignored. Thirdly, if we are comparing the performance of a same business over the years, we actually compare, let's talk about the sales. So maybe we compare the sales value, and maybe we can see that the sales value has actually increased over the years. But this increment does not adjust for the inflation, because every year the inflation also increases, making the sales price of the unit increase, right? So that's not actually considered while calculating our ratios. So that can be another major disadvantages or limitations. So ignores inflation. Alright, this concludes the sixth part as well as this question. If you found this video useful, make sure you like the video and leave a comment below. And make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.